Welcome back to Commercial Real Estate Now, your edge in retail real estate and smart investing. I'm Carly Iacono. Today, I'm diving into how tariffs are poised to shape the future of retail commercial real estate here in the U.S. Spoiler alert, this isn't just about foreign policy or trade wars. It's about rents, redevelopment, leasing velocity, and the wallets of your tenants' customers. So let's start with what drives retail consumer spending. When tariffs increase the cost of imported goods like apparel, electronics, and household items, those price hikes are often passed on to the consumer. According to CBRE, the current tariff structure could increase annual household expenses by $1,200, and that doesn't even count larger ticket items like cars, which could go up by $4,000 or more depending on the source. Because of this, consumers could pull back on purchases due to the higher cost, or at a minimum, be more focused on finding deals. Retailers are currently in a balancing act. They're managing rising inventory costs from overseas goods while also trying to maintain competitive pricing to lure in stretched consumers. As tariffs rise, input costs and inflation persists, retailers may see margin compression, and that could potentially cool their expansion appetite and make them more cautious in their leasing decisions. I think you should expect to see fewer store openings from mid-tier brands. Value and luxury could be less impacted, potentially slower lease-up for new developments, and increased requests for tenant improvement allowances and shorter lease terms as retailers hedge risks. Finally, there could be a behavioral shift towards domestic brands and locally sourced products, which could be a silver lining for certain retail formats, particularly regional brands, farmers markets, boutique operators, etc., which already emphasize American-made goods. But landlords should be preparing for tougher negotiations with tenants, especially in non-core locations. Another pinch point, construction. With tariffs on steel, aluminum, and imported equipment, construction costs are rising 3% to 5%, especially for build-outs that rely on imported materials. So if you're building ground up, repositioning a center, or even just fitting out a tenant's space, expect to budget more and brace for delays. Tariffs can disrupt global supply chains, leading to delays in material shipments and unpredictable lead times. To mitigate costs, we may see a shift in architectural designs and materials used, with a focus on domestically sourced or alternative materials. And if you're a developer, you may also see more conservative underwriting from lenders who are watching the economic outlook closely. Lenders may require more equity, reduce loan-to-cost ratios, or delay approvals until costs are stabilized. We could also see a demand for higher pre-leasing thresholds and tighter interest reserve requirements. So what should you do with all of this uncertainty? Number one, reassess tenant risk by category. Evaluate your exposure to tenants and sectors heavily reliant on imports, such as electronics, furniture, and fast fashion. These tenants may experience margin pressure, which can lead to downsizing or slower rent payments. Proactively engage with your tenants to understand how their sourcing, pricing, and customer strategies are evolving. Strong relationship always lead to better lease renewals and can help you get ahead of early warning signs. Number two, consider flexibility in your lease structures. Build in flexibility by offering shorter-term leases with renewal options. This gives tenants breathing room and keeps your space adaptable in a changing environment. For developers and value-add investors, reevaluate build-out budgets and refresh timelines. What was feasible 12 months ago may need a second look. Keep close contact with your lenders as well, as term sheets may change quickly. Tariffs might not show up in a site plan or a cap rate, but the influence is real. They impact consumer wallets, retail margins, construction budgets, leasing velocity, and even anchor tenant stability. But here's a positive twist. February 2025 was a banner month for retail commercial real estate. Sales volume jumped over 105% year over year, with $7.1 billion in retail deals. A major contributor? Significant investment in retail by the industry's biggest players like Blackstone and Blue Owl. Tariffs present new challenges, but they also push the retail real estate industry to think differently, to source smarter, build leaner, and invest more strategically. That's it for this episode of Commercial Real Estate Now, your edge in retail real estate and smart investing. I'm Carly Iacono, and I look forward to seeing you again very soon. Take care, everyone.